What's up? I'm Dan Fredenberg, and this is another Chance Encounter.
Hey, what's up? I'm Dan Friedenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Friedenberg, and that there is a commercial real estate building.
Today I'm joined with Trystan, and is it Trenberth? Is that how you pronounce that?
Yep, Trystan Trenberth. Thanks, Dan.
All right, sweet. A
I
good
think my
phonics.
name's probably easier than yours.
Yes. It's there have been some people who have mispronounced my last name a few times, but I got some great news for you today, Trystan. We are joined today by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors. That means investors, buyers, sellers, all that sort of thing. And you may ask yourself, why would you do that? And the answer is, if you've ever heard of off-market private deals that you're not supposed to be discussing publicly, they're also called 506B syndications, you should know that the SEC requires documentation of your prior substantive relationship, or else they'll get ants in their pants,
Absolutely.
and we don't want that. So I have people on here, and we discuss what's your core competencies, appetite for risk, all that kind of stuff as it relates to these deals. And the benefit for you is you'll learn how to more effectively communicate on the subject of commercial real estate deals, which I think is pivotal if you're going to make this part of your career or your investment strategy. But before we get too excited about real estate, Trystan, do you want to say a thing or two about yourself?
Sure, I'm a British-born expatriate, lived in Arizona for most of the last 18 years. Got into real estate through Rich Dad, Poor Dad about 5 years ago, and been in the single-family game primarily, but branching out into bigger asset classes.
I love that answer. I love that answer. So, the first section we always do here is the five distinct motivations. Before I do that, I got to say, but wait, check your eight. And Trystan, I don't know if you have this uncanny ability to see through the camera into the user's device, but down there might be this hideous looking subscribe button that maybe, they can do some. Okay, it's a silly joke, but whatever.
We
The
can smash the like button, we can smash the subscribe, hit the bell, whatever we need to do.
Exactly, make it happen. That's the whole idea, and we'll figure out more about that later. But the five distinct motivations. At this point, I've now spoken to literally hundreds and hundreds and hundreds, possibly more than 1,000 different commercial real estate players, and the fact is, these deals, they take months to close, they take years to go full cycle, and so it's really important that we know what's going to keep people from throwing in the towel, what's going to keep them from giving up when the going gets tough. And even though we all have our own unique why, I find they fit pretty neatly into these five different categories. The first one of which is preservation of purchasing power. What on earth is that? Well, some people, they don't need to have a job to pay their bills. Instead, they have a portfolio of assets, and the way they pay their bills is from the proceeds, the profits of ownership. And the question might come up, why would somebody in that situation go through the hassle of another acquisition? And there's a couple different scenarios. One is if inflation is rearing its ugly head, that's going to eat away from the purchasing power of your cash flow, and it's going to be time to make a new acquisition. The other times is when there's a distressed property or an asset crash, and that way they can buy at a steep discount, which is what everybody really should be doing, but that steep discount is what's going to make people more excited to pull the trigger. And full disclosure, I'm not at this point in my career yet. What describes my situation more accurately is that I'm trading time directly for wealth. And that's because of my background in tech. When you are a high wage or high salary earner, you're going to be paying more in taxes than anybody else. And while I was doing the sending 5 to 7 million emails a month and doing all the web-based applications and the credit card transactions, the different online requirements for that, it hit me that maybe I should be more like my boss. And from 2014 to 2020, that boss was flipping 10 houses a month like clockwork, and he was doing that for years before he hired me, but his tax burden was much lower. So it hit me that I really ought to pivot and figure out a way to get rewarded in the form of deployed capital, aka these little slivers of equity. So that's why I'm involved in real estate. But that's too subtle, especially for a lot of youngsters. What they tend to be more find more appealing is the idea of hustling like crazy right now and fast tracking their retirement, or at least some version of taking control of your schedule. Maybe it means working fewer months per year or fewer weeks per month, something like that. But dialing back is really the key for some people. And honestly, it's to the point where a lot of people who choose this one, they think that it's secretly the motivation of everybody in this industry is to retire. But I assure you that is simply not the case. For example, some people are fueled by ambition. They want to buy their entire hometown. They have to have their name in great big letters on some huge building or something like that. They're after that generational wealth to make sure that their great grandchildren never have to hold a day job. And that's why they're going to be hustling into their 90s, which makes them fantastic parts of any GP team, even though some sectors try to vilify them. But the last group of the bunch, they're similarly motivated to keep on hustling into their 90s, but instead of being for their own children's sake, they maybe picked a sector of society, or maybe it's the environment, or maybe it's animals. Maybe they want to send people to space. But regardless of what this big goal that they have is, there's a financial component to making it actually real. And that's why some people are making their commercial real estate acquisitions. So Trystan, of those 5 different motivations, what combination of those would you say describes you best?
Absolutely freedom of time and choice of what I do. I talk about theoretical retirement, which is when cash flow exceeds my cost of living. And I can retire if I choose, but I'll keep on doing deals. I'll keep on doing things that are fulfilling, philanthropic, ventures, and just creating the freedom to be and do from wherever I want to on the planet.
I love that answer. I love that answer. And of course, when we're talking about motivations, it's really easy to seem overly optimistic. And of course, there are risks involved in every single type of business. Real estate is no exception. But one thing I found, if you've ever been involved in a 506B syndication, whoever the securities attorney in the mix was, they should have insisted that everybody involved fills out this super invasive questionnaire, this financial questionnaire, sometimes called a suitability questionnaire. And if there was no securities attorney involved in the deal, then you should not just walk, you should run away, because the SEC will have something to say about it and it'll be a total house of cards. But in the questionnaire itself, when I was going through it, there was one question where I felt the question lacked utility. I couldn't really use any of the possible responses. So I made my own one, and it was for this tolerance for risk assessment. It's a fill in the blanks question. And it is. There are many popular investment asset classes, but I think blank is too risky. So Trystan, it could be inside real estate, it could be outside real estate. What's too risky for you?
Anything that I don't know enough about to make a logical and reasonable, rational decision. It's as simple as that. It could be inside or outside, but if I'm not well informed, I'm not confident. I like the most wealthy on the planet. They have the lowest risk tolerance, but they're most consistent with the way that they apply their risk mitigation, and they're always consistent with the results over the long term. So if we don't know enough about it, it could be a $5 bill, it could be a $50 million asset. If we don't know enough, it's not worth the risk.
I couldn't agree more. I love that answer. It brings me, though, to the favorite deal metrics. And I'll confess, this slide here, I avoided including it for the first couple hundred chance encounters. And the reason for that is because some people in this industry, they're more of a public relations role or marketing. They're the front of house. They're the pretty face. And those people, they're not going to be the type who are real underwriters, where they're going to be digging into those spreadsheets and understanding every single metric And what I did decide to do, though, I started including this because no matter where you are on that spectrum between every metric matters and just a few core ones to pique your interest and you're really more dependent on your deal sponsor, there still should be some sort of answer for this. And this is not an exhaustive list of metrics, but for anybody in the audience who's only listening and not reading, not able to see it, I'm going to read them all out individually, and maybe we can get your top three or something like that, Trystan. The answers are cash on cash, IRR, cost per door, net operating income, which is also called NOI, the going in cap rate, which is the difference between what you're paying for the deal versus what the going rate is in that area during that month or whatnot. Then there's the loan interest rate, which is especially important if you're going to be assuming a loan. Then there's the occupancy rate, which is the inverse of the vacancy rate, but it's the same thing. The average income where the property is located, the amortization period of the loan, the difference between the market versus the in-place rents, the population growth where the property is located, so you have some baked-in appreciation from demand right there. The sponsor record, which is how many deals have gone full cycle, how many are on the go right now. The waterfall, split, or exit strategy, which is what happens after your capital has already been returned. And then I have DSCR, which is debt service coverage ratio, which is how much of the revenue from rent is going straight out the door automatically just in terms of the cost of the loan. Now, Trystan, you're welcome to use any numbers that are not on this list, but which ones do you...
I think there's a few key ones here. I mean, at the end of the day, when we buy, we already have to have the exit strategy already taken care of. We know we need to know what the exit is in a multitude of different situations. If the market projections go up as predicted or beyond, we also need to know what the exit is if the market doesn't appreciate as projected, and we need to know what that plan B is. So between plan B, debt service coverage ratio, that's obviously going to affect cash on cash and NOI. And with population growth, average income, it comes down to, is that sponsor's record true? Is it effective enough? And is it reliable enough through transparency and speaking to other investors they previously worked with to gauge their experience, to know whether that's an experience or relationship I want to build?
I love that answer. I'm just eating it up like a delicious subscribe sandwich. It's very subtle, that little message here, but it's how I get the reminder to pull out the Dan Does Deals Commercial Core Competency Cube with the 6 different roles in a commercial real estate deal. And I go through all 6 sides in every episode because, once again, it's important to me that you learn how to more effectively communicate on the subject of commercial real estate deals, because if this is going to be part of your investment strategy or your career, it's going to hinge on your ability to communicate effectively. And if you're watching this and thinking, wow, I really would like to get me one of those, the good news is it's absolutely free. You go to dandoesdeals.com, there's this big conspicuous looking button you can click on and download and print it out, and then that way you can practice on your friends, family, and whoever else, just so that you can really nail expressing what each of these different roles are, and you can spot from a distance whether a deal has some fundamental problems that you should keep away from. And I have to confess, I committed the cardinal sin of marketing, which is you should always ask for some sort of contact information in return for your freebie. I didn't do that. I just made it so if you go to dandoesdeals.com, you can just print it out for free, and I don't even ask you for any of that kind of stuff, which is a terrible idea. But once again, that's how important it is that you learn this stuff. So let's go through the 6 different roles. The first one is the most visible of the roles, the repositioner role, because they are acquisitions people. You're more likely to meet one of these than anybody else. And the reason why I call them repositioners is because they're trying to figure out how to find upside. So they're looking at a whole whack of different properties. They're doing a whole bunch of paperwork. They're underwriting the deal. They're figuring out, first of all, is this property even making the amount of money that the seller/broker is claiming it is? Because Okay, so the repositioner has their work cut out for them, understanding the business, understanding how they're going to improve it. And one of the more peculiar parts of being a repositioner is that you have to have a vast network of financiers. Those are people who only deal with paper, money, and whoever owns the actual property. So they're not dealing with residents and they're not going to be on the GP team, okay? But the repositioners have to have a vast network of financiers because if they can secure a more advantageous loan, that goes straight to the profitability of the building. So they're always looking for cheaper money. So that's why repositioners spend so much time with financiers. But the next spot where a repositioner is going to look is far more intuitive. They're going to look at operations and say, how do we get those Benjamins to stop going down those toilets? But of course, there's more to operations than just unclogging toilets and collecting rent and mowing lawns and possibly even shoveling snow or whatever. Me personally, the contributions I make to operations, there's a couple of them. One of them is any sort of web applications, different websites, different online content and media, whatever. I'm happy to hop in and help. But of course, I tend to focus on deals that are 100 units or more, and usually you end up outsourcing the property management to a third party if that's the case. So, what will a guy like me be able to bring to the table? Well, you have to understand that in real estate, vacancy is the enemy. And that means that if your third party property management can't get those units filled, somebody on the GP team needs some serious marketing chops so they can get those units filled. And that's where I end up hopping in that situation. But the next place, when you've exhausted all the options for more efficient operations, the repositioner will frequently get a contractor team involved to upgrade the property, to renovate, make it a nicer place. The idea being that the next resident should be happier to live and pay more in rent for that property than the previous one because it's nicer. But if only it were that simple. You can spend endless amounts of money on contractors, but that does not mean you're going to get a return on investment, especially if you're out there gold plating toilets and doing silliness like that. So if you're like me, I don't know if you know this about me, but I'm from the internet. So that means I need locals. I need boots on the ground, somebody who can be there in an hour or two, because categorically that will not be me. I'd still be stuck at an airport in an hour or two. So I definitely need to rely on these locals. They're going to make sure that the contractors aren't dragging their heels, that they're not using subpar materials and whatnot, and also making sure that the operations aren't basically sloughing their photos and details. But it's time for a hypothetical. Let's say you decide to become a repositioner. Maybe you're thinking, hey, I know how to buy a house. You have a deposit and then you get a loan for the rest. Maybe my circle of friends and we can put in 100K each or something like that because we're engineers or attorneys or physicians or something like that. And then we can take over that 350 unit apartment complex that's down the road. So as a repositioner, you turn around to the financiers and say, hey, I want to buy that property over there. It's tens of millions of dollars. You don't have, I don't know, say tens of millions of dollars you want to lend us, do you? Well, the financier is going to have one question that I haven't answered. And if you're in a mentorship program or you have a guru, I highly encourage you to listen very carefully to this next part, because the reason why the financiers are going to say no is because they're going to ask, who's the sponsor? Who's the KP? What's that all about? In order to be eligible for a commercial loan, the bank's going to require that somebody in the fold already owns a similar asset. So they're not going to lend you money on a 350 unit apartment complex unless somebody already owns a 350 unit apartment complex and therefore demonstrates to the bank that you're not going to run it into the ground and lose all of their depositors' money that they're lending to you. So you have to have that in tow. On top of that, among the GP team, you need to produce a certain amount of liquidity. And then as far as collateral goes, the GP team needs to sign for a balance sheet that's at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So Trystan, as far as these different roles in the deals, what are the most likely pieces that you're going to contribute to your next deal?
I'm more of I'm a super connector. I build relationships. I put people together. So I'm not really one of those on that die, but I'm a relationship builder. I put people together, and I engineer some sort of structuring of deals, but just put people together for success and participate in the ones that I choose.
I love it. I love it. So that repositioner part is and financier relations is probably the more major bits that you're going to be taking. And there, I'm just clicking, and now I've got my face eating this up. But let's talk about people. So my favorite thing about commercial real estate is because it's multifaceted. You've got these different roles. People are so eager to make introductions, give referrals, build new teams, even if they're not on those teams. And the thing that's beautiful about that is it means that we're just so friendly compared to other industries. Now, you're also going to be forced to bear down on one or two of the different roles. And when that's the case, your skill set, your unique skill set, is going to mean that you're better off helping some people more than others. And me personally, it's always the sponsors and key KPs that I'm eager to speak to because they've already got a foundation in their business all put together. So I'm eager to speak to them. And then at the end of the day, we're in the business of deploying capital. So financiers, I'm also eager to. So before we get into the buy box, Trystan, who's out there in the audience that you're most eager to speak to?
Again, financiers, people that have deals that need teams, and I'm connecting people and building those relationships, building those collaborations.
Excellent, excellent. So it sounds a bit like you're similar to me, where I'm more dependent on the deal sponsors themselves. So I'm a little bit deal agnostic. It has to have meat on the bone, and I understand the fundamentals, and that's what I prefer. But let's talk about that for a second. When real estate people are asking, "Hey, what you looking for? What's your buy box?" We're really asking for three main things. First one's geography. Where is it? Which state, which county, possibly even which neighborhood. That's absolutely going to be important. Second one's going to be size. The size is important because the type of group that takes over smaller properties are going to be fundamentally different from the ones who take over big ones. And most of my guests on this show are in multifamily, which is apartment complex investing. And the way you define size in apartment complex investing is by the number of apartment units. So a 15 unit apartment complex is going to have a different type of acquisitions team compared to 150. So that size is going to matter. Of course, other types of real estate, they may go off of acreage or they may go off of square footage, but still that size is going to matter for that reason. But the last one is normally called class. I prefer the term desirability because I think it describes it a little bit better. But the reason why I really don't like the word class is because it's two things, not one. The first one's condition. The second one is area. And when you're talking about condition, it's how old is the building? How beat up is the building? What about luxuries and amenities? Is it a really nice place to live, or is it kind of bare bones, no frills sort of thing? That is the condition. Whereas if you're talking about the area, because we're talking about multifamily, the school districts where the property is located is going to be very important. But every type of real estate is going to involve the crime rate where the property is located. And then there's that old trope where they say location, location, location. What I think they really mean is traffic, traffic, traffic. If more people pass by a property every single day, it's going to be more desirable than a place where it doesn't have much population at all. But both the area and the condition are ranked the same way as in grade school, where you have A plus at the top, and then A minus, and then B plus. So Trystan, as far as you and your group goes, what's easier to say yes to?
Generally, B minus, B plus, neighborhoods and condition. There would be some forced appreciation we can create as part of the exit strategy. Mm-hmm. And we don't necessarily want elevators and some of the facilities that, when there's a problem in the market, people always downgrade from A to B, and we can capture that market. It's kind of like the single family game of the median price flip. That's always going to be the most captive market, the easier to sell regardless of what happens with the market. It's a good, safe place to be. C neighborhoods tend to come with a little higher crime, less desirable from an operator standpoint. And, you're getting more problems in that category where you're benefiting from A to B transitions instead of B to C transitions.
Mm-hmm, mm-hmm. All right. And then as far as the states go, where's ideal?
Sunbelt landlord-friendly states, so not California, maybe Texas, Arizona.
Mm-hmm. Beautiful. I love it. I love it. So then if you're in the audience and saying, how do I reach out? Well, first I'll sandbag the conversation by talking about myself. I'm lucky to have this distinctive last name. It makes me really, really easy to find on LinkedIn, which is the platform where I spend most of my time. So that's a great way to reach me. Of course, you can also find my books on different parts of business and skill building on Amazon.com. But if you are going to be involved in syndications or these different investments, it's a really good idea to make sure you have that documentation of your substantive relations taken care of. So if you pause the video, you can scan this QR code that's right there on my screen, and that brings you to the FAQs page of 506BME, which is the platform where I offer that service. The idea being, if your laptop falls into the bathtub, you're still on the hook for supplying that documentation to the SEC. So it'd be good to have some IT service where you're not going to worry about that as far as backups go. But Trystan, if people want to reach out to you, social media, website, phone, email, what are the best ways to reach out?
Social media, Trystan Trenberth, Instagram, Facebook, and LinkedIn. And you can watch my podcast, Birth to Net Worth, where we talk about people's first relationship with money and how that's evolved over time. And look out for Midlife to Millions, which is my forthcoming mastermind education platform to help people change their living into the American nightmare of consumerism and instant gratification, and actually taking control of their retirement and creating the American dream for retirement, and maybe retiring even early.
All right. I love it. I love it. And that brings me to the last thing I always do here, which is the public service announcement. So it's not specifically for you, Trystan. If you've been watching this episode and you've been experiencing searing pains in your eyeballs and like migraine-like symptoms, I'm confident it's due to the downright hideous subscribe button that's just down there. And you can click on that for free. It's full disclosure. I want many people to click on it because then YouTube will actually start to pay for these videos instead of me. And I think that would be wonderful. The trade-off to you, just so we're clear though, is my videos may show up on your list of suggestions, but quite frankly, you can go ahead and ignore those suggestions. I just really appreciate the fact that you spent this time with me. Just like Trystan, I appreciate you joining me. This has been great.
Thank you so much, Dan.
Awesome.
Appreciate it. Thanks.
Great, thanks. Hey there, are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, and all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay. Are you already logged into 506BME?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506BME, everybody.